Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Devina Khanna and you're watching Indian Open. Let's go straight to the headlines. Yes Bank's net profit fell over 90% in the first quarter as the lender continued to clean up bad loans. Wipro's profit declined in the first quarter as higher wage costs and a stronger rupee dented margins. The Union Cabinet approved 7 changes to the Insolvency and Bankruptcy Code, including more powers to the Committee of Creditors and extension of the resolution deadline. And the International Court of Justice orders Pakistan to suspend Kulbhushan Jadhav's death sentence and to allow him consular access, marking a big diplomatic victory for India. All right, coming back to what's been happening in terms of the market setup, looking at a slightly subdued global picture. So when you're looking at US, you are seeing a slightly more subdued trade across the board. S&P 500, Dow Jones and Nasdaq saw cuts of about 0.5%. It's getting slightly more mixed bag in terms of the earnings outlook that have been coming in from there. And considering that the run-up has already been so steep and sharp, investor tolerance for any sort of disappointment starts to become really short. So you've got to keep that in mind. And now only 2 weeks left for the Fed's decision on whether or not it's going to cut those rates, and investors are baking that in. But if you look at the Fed's beige book, they're talking about things improving on ground. However, a labor market continues to be slightly more tight. But Asia is a pocket following suit with what the US equity markets have done. Asia is looking weaker this morning. Nikkei 225 is trading under by 1.5%. Shanghai is down about 0.75%, while Hang Seng trades a little lower than more than 0.5%. SGX Nifty, a quick glance there, it's down about 0.2%. So the setup looks slightly weak. You could see a slightly weaker open as we step into trade. Aside from that, keeping in mind what we've got in terms of the OI distribution and which levels are more crucial and important. Remember, up until now, it is fairly range bound, a 50-point range that we've been seeing. But we've seen big moves come in the last few days of trade. Watch out for levels of 12,000. This is the monthly expiry, 25th of July. So the maximum call open interest still lies at about 12,000 strike call, while on the downside it is shifted to about 11,300, so that range has become slightly more wide. Activity with regard to institutional investors, domestic and foreign. Yesterday's session saw marginal selling from the foreign institutional investors, while domestic institutional investors have been chipping in their bit over the last few trading sessions. They've been on a daily basis accumulating a little more. In yesterday's session, a marginal sum of about 209 odd crores. Earnings to watch, the key numbers that come out today that you need to keep an eye out on. You've got L&T Infotech, ACC, Colgate-Palmolive. Watch out for that one. Expectations are that you will see a weaker volume number. DB Corp, Hudson Agro, and Sterlite Tech is the other one that you need to keep an eye out on. Aside from that, these are the results that are going to come out today. Some that came out yesterday post-market hours, and that could have a big bearing on the stocks as they open up for trade this morning. First one, Yes Bank. A complete trash out. Net profit was down 90% to about 113.76 crores. Remember, Bloomberg estimates were somewhere closer to 200 crores. That's a big miss on the profits. Even with regards to the net interest income, that was a big miss. Asset quality continues to deteriorate. 53% sequential jump in bad loans. Gross NPAs have spiked up on a quarter-on-quarter basis. Net NPAs have also gone up. So overall, provisionings, while they are at about 43.1%, they expect it to move up. Most of the brokerages have cut their target prices on Yes Bank. 110 is what Edelweiss has given it. Then you've got CLSA. Though they've maintained their outperform rating, the target price has been cut to 110 from 150 earlier on. They're talking about capital raising going to be the key focus for Yes Bank. And, aside from the fact that you've already seen a big slippage number, more than 10%, which is primarily coming in from the double B rated book and below, expectations are that could question the 10,000 crore watch list that they've given. And going forward, you could see further slippages happening from the triple B rated book as well. So watch out for all of those factors. Though the management was pretty clear that much of the cleanup has been done, next quarter onwards, growth should start coming in. But the question remains, with the growth capital just at those regulatory levels of 8%, even with a fundraising of about $1 billion, that brings it up to just about 11%. So where will that growth come from? Aside from that, you've got another one, Wipro, Q1 guidance missed. The IT services revenue was down 1.8%. EBIT margins came in at 16.6% versus 17.8%. Mindtree was the other big disappointment, so you might see the stock seeing a big cut in trade as it opens up. Net profit was down 53.3%. Revenue saw a marginal uptick of about 0.8%. And the other stock to watch out for, Sudarshan Chemicals. You've got Amansa Holdings, which buys about 1.39% stake at a price of about 315 rupees per share. Stock's at about 318. Currently, in yesterday's session was up about 1.3%. But moving on, and first word today, Agam Vakil will join us with what stood out in Mindtree's earnings. Next, Shefali Malik will examine Yes Bank's earning to find out how far the bad loan cleanup has progressed. Bajaj Finance and Bajaj FinServ are fast becoming investor darlings like HDFC twins. Navneet Saluja will tell us if they can create similar value for shareholders. And HDFC Asset Management Company is doing its parent proud with stellar returns. Samit Sirkar will tell us what's working for the company. All right, Mindtree, which has just become a Larsen Toubro company, reported a weak set of numbers for the first quarter. This despite reporting record deal wins in the quarter. Agam Vakil, he's here to tell us more about the numbers. Agam, it looks like L&T's got a big job at hand.
It certainly has, Devina, but the margin contraction was for a one-off, and I'm sure there'll be a lot of concerns with respect to margins coming off, but let's address them then in just a bit. Let's start off by the numbers, and when it comes to the revenue growth, again, we're looking at a 0.3% decline. That's largely on expected lines. Sure, it may have been a little bit of a miss, but then in that case, a lot of companies have seen a little bit of a miss in terms of revenues. Of course, we've seen a sharp decline in operational profits. That explains the drop around 31% in your EBITDA. EBITDA margins coming off by 480 basis points. Alarming on the face of it. Yes, a lot of people will question, but we'll come to that in just a bit. Profits consequently have dropped around 53% from 98 crores to 93 crores for this particular quarter. Now, in terms of new orders, the company has actually signed record signage of around $324 million, and 40% of these orders come from your digital revenues, the digital business, which they have gone and broken down. So it certainly turned out to be a decent quarter when it comes to new wins. EBITDA margins, on the other hand, if you exclude the one-offs, which we will be talking about, that's come off by around 260 basis points. So there you have it. And not talking about margins, where is that big hit coming from? So we do have about 990 basis points planned wage hikes. We have about a 30 basis points increase in higher visa costs, as has been the case in many of Mindtree's peers, and forex headwinds of around 40 basis points on the back of a strong rupee against the US dollar. However, Mindtree has paid a special compensation to its employees on the 20th year anniversary for Mindtree, which is why we're seeing an additional 220 basis points hit for the margins. And of course, this is going to be a one-off, which is why a lot of your other operating metrics have been mentioned because of excluding one-off. So on the whole, this part of the equation may not be much to be worried about. However, we are looking at that wage hikes, which is again a part of seasonality. So what really comes down to, it boils down to 70 basis points in higher visa costs and forex headwinds. Forex headwinds again is going to be a function of the rupee. So it's been, I would suggest that it's been a fairly stable quarter, even in terms of operations, despite the fact that we have seen a 480 basis points decline in EBITDA margins.
Right, and how did the individual verticals perform, Agam?
Right, well, so they did very well, as I've already mentioned, that they have signed, contracts worth $324 million, and this is, of course, a record signing for them. The growth has been led by travel and hospitality. This vertical has done very well for them. On the other hand, high-tech and BFSI, well, not doing too well. They have gone ahead and broken down their digital revenues business for the first time, and they will now give us a better idea of the digital revenues through interactive, data sciences and engineering, and cloud services. So these three will form the major part of your digital revenues for Mindtree. Moving on, of course, we're also keeping an eye on how these verticals have done. So as I was suggesting, we did see weakness in BFSI and high-tech and media. High-tech and media is their largest vertical. So it is an important one for them. On the other hand, travel and hospitality is done well. And of course, retail remains flat, but we must understand that a lot of this has to do with the retail sector in general in Europe and US, which is why it's seen a lot of volatility. On the whole, if you disregard the sharp decline in operating margins, it may have very well turned out to be a decent quarter for Mindtree.
All right, we'll wait and see how the stock actually opens up
Yeah.
trade this morning. Agam, thanks very much for that. That was Mindtree for you. Moving on to the big one then. Yes, Bank reported a 90% decline in profits in the first quarter. Provisions against stressed assets on its books eat into the bottom line. Shafali Malik, she's standing by right now to run us through the fine print of Yes Bank's numbers. Management is of the opinion that they've got the house in order in this quarter, and next quarter onwards, it's going to be a turnaround. It doesn't really look believable.
Well, yes, it doesn't really look believable. Even at the time of Q4, when the management said that, now it'll be consolidation, etc., they guided for 125 basis points credit cost. That time also, and a watch list of 10,000 crore rupees. That time also, there were several question marks raised that, whether this is believable going by the history. So even now, when the management has put out and they're trying to tell the investors that it's all in order, but, not many are believing the same. So starting with what they actually did in the quarter, their NII went up just 2.8%, which was below expectations. Profit fell 90%, again below expectations. Then NPAs rose sharply. The gross NPAs in absolute numbers went up 53%. In percentage terms, 5.01% against 3.22 on a sequential basis. So a sharp rise there as well. Net NPAs as well because of higher provisioning. So net NPAs went up to about 2.91% versus 1.86%. And provisioning, if you remember in Q4, they did about 2,100 crore rupees contingency provisioning for the watch list accounts. So out of that 2,100, they actually used about 1,400 crores. And as far as the fresh slippages are concerned, management said it was to the tune of about 6,200 crore rupees. Out of that, 2,500 crore rupees is the one which actually slipped from the watch list guided earlier, 10,000. And yesterday in the con call, management again guided a watch list of about 10,000 crore rupees. So that means if had these, that means they've added it. So that means had these accounts not slipped, the watch list would have been 12,500 crores. So that's one catch there. Other than that, provisioning went up, came in at about 1,784 crore rupees, 51% lower than what it was in Q4, and the coverage ratio is just about 43%, which is a big concern for them. And other than that, credit cost came in at 32 basis points in this quarter. Guidance has been maintained at 125 basis points, which does not look believable.
All right, so, obviously the management had its con call. What were the key takeaways from that con call, specific to the asset quality?
One of the big points in the con call was that the BB and below book, that is a below investment grade book, that has risen very sharply from 23,000 crores at Q4 end to about 29,000 odd crores. And the 6,000 crore rupees gross slippages that have happened, out of that 2,500 crore rupees is coming from the earlier watch list, which I just talked about. So that is, a rest came from the sub-investment grade book. Their BB and below book increased sharply, mainly on account of downgrade of two financial services companies, which we've spoken about in last couple of months. Watch list, they say, continues to remain 10,000. And also, other than that, they're saying that 25% of real estate exposure is in BB and below book. So that is one big number which we have to watch out for, considering the stress in the real estate sector as well. 125 basis point credit cost guidance does not include the MTM on the investment provisions. So all these downgrades that have been happening of DHFL, ADHE group companies, Z, etc. So the investments that they have in the bonds of these companies, so that the provisioning that they need to make on those accounts, so that has hit them in this quarter. And if they actually, these companies, more such downgrades continue to happen, what's going to happen to those investments, and whether there will be a further markdown to the investments that they already have. So that is one key thing to look forward to.
Yeah, and the other part also that I was going through some brokerage notes which suggested that this time around, while the slippages have been more than 10% on the account of the BB rated book, the BBB rated book could be another concern as we move forward.
Yes, absolutely, because like so many accounts that we've been watching in last couple of weeks, they've been witnessing downgrades after downgrades. So we do need to watch out for these grades as well.
And the capital raising that we've also been talking about. Even if they have to do $1 billion worth of capital raising, their current CET tier 1 is about 8%.
8%.
That's the regulatory level that they have to be at.
Yeah.
Even if they raise about $1 billion, you take that up to 11%.
Yes.
Is that enough? I mean, the growth capital, it doesn't seem to be enough.
Yes, doesn't seem to be enough. So all eyes would be how much they actually end up raising. The management said that the dilution could be more than 10%. So the first tranche, as we reported earlier, could be from a PE player. So we need to watch out for that, how much they actually raise. And because of that capital raising, how the overall business momentum also picks up in the bank. So that also may contribute to their overall earnings simultaneously. But then purely standalone, the amount doesn't look, enough.
Sufficient, yeah. Shefali, thanks very much for that. Obviously, it's going to be a bigger question on whether or not the shareholders get shortchanged in the process of this or no. But that's Yes Bank. Do anticipate a bigger lower open this morning. Bajaj Finance and Bajaj Finserv have become the poster boys in the NBFC space. The Bajaj twins have managed to buck the trend at a time when their peers had a really rough ride. That in turn has prompted investors to draw a correlation with the poster boys of the banking space, HDFC and HDFC Bank. But can they really create the same amount of value returned by the HDFC twins? Navneet Saluja D'Souza, she's here. She's going to attempt to answer that question for us. Navneet, take it away.
Thanks for that, Davina. Good morning. Well, clearly the Bajaj Finance, Bajaj twins have emerged out to be the darling of the street. And in terms of generating shareholder wealth, definitely they are on the same path, what we've seen from the HDFC twins in the last decade. As you can see here on the chart, we have put HDFC Bank and HDFC's performance here, where HDFC Bank has given you almost 6 times return in the last 10 years, whereas the Bajaj twins have given you phenomenal return in the last decade. 148 times is the return coming in from Bajaj Finance and almost 27 times return coming in from the Bajaj Finserv space. Remember, Bajaj Finserv is the holding company for Bajaj Finance. So in terms of generating shareholder wealth, they seem to be on the same path. But if you also compare how they have weathered the storm of liquidity crisis, which was triggered by IL&FS in September last year, both Bajaj Finance as well as Bajaj Finserv, which are also the Nifty constituents, have been an outperformer. In fact, on Y-to-D basis, Bajaj Finance is the top performer on Nifty, up about 31%, and Bajaj Finserv is up about 21%. Though HDFC twins do not feature here in the top 10 list, but they too have given you positive returns of between 13 to 16% respectively. In terms of market cap, there's a long way to go for Bajaj Finance. If you look at the combined market cap of HDFC twins, it stands at 10.4 lakh crore, and for the Bajaj twins, pardon me, is at 3.2 lakh crore. So HDFC twins market cap is almost 3 times the market cap of about Bajaj twins. So there's a long way to go in terms of increasing the market capitalization. In fact, even if you look at the weightage, now all the 4 stocks are constituents of Nifty 50. In terms of weightage, in 2009, the HDFC twins had weightage of about 9%, which increased to about 19% as of now. So this is one group which has majority weightage on the index right now, whereas the Bajaj twins, they did not have any space in the Nifty index in 2009, but now they do feature among the top, among the Nifty constituents, but the weightage right now is quite meager of about 3%. But look at the valuation picture now, considering because the stock price has been outperforming in the last decade or so, valuation wise, both Bajaj as well as HDFC twins, compared to their peers, they seem to be on the expensive side. In fact, Bajaj Finance is the most expensive NBFC that's trading on the exchanges right now, with price to book of almost 8.2. We've just tried to compare the current price to book vis-a-vis the 5-year average that we've seen. So this is for HDFC. Currently, it is trading higher at about 4.7 compared to its 5-year average. For the bank, it's slightly lower at about 3.9 compared to 4.6. And for Bajaj Finance, because the stock has been outperforming, of course, the street tends to assign higher valuation to companies which generate better value for the shareholders. So 8.1 is the current market cap. current price to book vis-a-vis 9.4 of average last 5 years, and for Bajaj Finserv 4.2 compared to 4.7 that we've seen in the last 5 years.
Right. Okay. So while you've set this up for us, let's talk about the core operations and financials as well. It looks like the Bajaj twins have a lot of ground to cover.
Absolutely, Devina. They have a lot of ground to cover, and we've already highlighted in terms of book size and also market cap, there's a long way to go. But in terms of generating shareholder value, of course, they're on the same path as HDFC twins. So here's the performance, the 10-year CAGR of all the four players. For HDFC Bank, if you look at the NII growth, that's the net interest income, difference between interest earned and interest expended, CAGR growth of about 21% in last 10 years, and on the profit front, it is about 24%. And we know this by now. HDFC Bank reports earnings. The growth has been hovering between 20 to 25%. And similarly for the mortgage lender, HDFC, 16% is your NII growth that we've seen. The total income growth and the PAT has been 15%. Now, returns for Bajaj Finance, once again, will be on the higher side because it's also coming out of a low base. It came into the market much later than HDFC. So for Bajaj Finance, the total income in the last 10 years, there's a CAGR growth of 39%, PAT growth of about 52%, and for Bajaj Finserv, 15% is their total income growth and PAT growth of about 31%. Remember, this is the CAGR growth that we projected of last 10 years. So in terms of growth levels, you will see higher numbers coming in from the Bajaj twins because it's been coming out of low base. But look at this, the size. I know it's not fair to compare an NBFC to a bank, but I'm just trying to project the numbers here. So Bajaj twins, the total asset under management is at 1.1 lakh crore vis-a-vis the HDFC twins. It is at 12.8 lakh crore. I think the fair way to project this will be how it has grown in the last 10 years. In fact, if you look at Bajaj Finance back in 2009, I think the AUM was somewhere about 2,500 crore, which has now come to about 1.1 lakh crore. Actually, that's an increase of about 47 times. So this is going to give you a better picture of how the AUM, the assets, and also the loan book of HDFC seems to have grown in the last 10 years. In fact, if you look at the CAGR returns of both AUM as well as the advances which have been dispersed. So for assets under management of Bajaj Finance in FY12, it was about 13 lakh, and in FY19, it's at 1.1. So that's a CAGR growth of 37% that we are witnessing for Bajaj, and pull up for HDFC as well. They've been pretty consistent. In fact, if you look at HDFC, the mortgage lender, the growth is about 23%. That's the 10-year CAGR return. And for HDFC Bank, that's about 26%. So what's actually emerging out to be a good space for both these group companies? I just want to go a little journey back. Retail focus by both these companies have actually turned out to be a boon. I think in 2 decades back, HDFC tapped the home loan market, and without falling into any sort of pitfalls of bad underwriting, I think that's helped them. And for HDFC Bank in the early 90s, they tapped the retail market very well. That was the time when other private banks and the PSU banks were focusing on the corporate loan book. If you look at HDFC Bank's loan book mix, it's still 50% goes to the retail segment, and that's the reason why they've outperformed their peers as well. And of course, the prudent lending practices that we've seen. And for Bajaj, I think that's practically invented the consumer lending space. It was unheard of a decade back that, at cost-effective rates, one could finance buying of electronics, white goods, or even clothes. For some of the loans, actually, it's even 0% rate, which is coming out. And lastly, good parentage, good governance that market actually wants from good players to assign higher multiples, which we've seen for both these companies. Back to you.
And considering that there's really a scarcity of these high-value, high-growth companies, you'll probably land up paying much more in terms of multiples, even if you have to. Thanks a lot for that, Navneet. So watch out for all of these 4 names. Moving on, we're going to carry on with the HDFC theme. The other stock from the HDFC stable that's creating a lot of value for investors is HDFC Asset Management Company, which is trading at live highs now, giving 88% returns to investors who subscribed to the IPO in August just last year. What's working? Let's find out from Somit Sarkar, who's joining in right now. Somit, what's working for HDFC AMC? A clear winner in the pack.
So I'll firstly briefly touch upon the share price performance of the company since listing. Now the company got listed on August 6th and the issue price at that time was 1100 rupees, and on the listing day the share price closed at close to 1816 rupees. That is the listing gains of nearly 65%. Since the listing day, the share price have also continued to gain at around 14% from August 6th till yesterday, while in the same time period the benchmark index, that is the Nifty 50 index, has only gained close to 3%. Now if you see the share price chart of HDFC AMC, you can clearly see how it was volatile, at how the share prices were volatile at one point of time. It even declined below 1300 rupees, and that was mainly because of two reasons. Firstly, the volatility in the equity markets, which had led to lower flows in the mutual funds, and secondly because of the cut in the total expense ratio, which would result into lower incomes for the asset management company. So these were the two concerns at that point of time that led to this sharp drop in the share prices of HDFC. Even post that, if you see the share price chart of HDFC AMC, there has been a couple of sharp falls in the share price, and that was because of the FMP exposures to the SL group, and that's the reason there have been these two sharp falls that we are seeing in the share price chart of HDFC AMC. However, despite all these factors, the stock has gained, and it has gained more than 4 times the benchmark has given returns to investors, that is around 14% as compared to a 3% return of the Nifty 50 index, and that is because of a steady SIP flows that we have been seeing. Now the monthly SIP flows have remained stable at close to 8,000 crore rupees, and that has been one of the key factors that has been leading to this gains for HDFC AMC. Secondly, the company was able to pass through nearly 95% of the impact of the reduced total expense ratio to its distributors, thereby maintaining its earnings. Now, of the overall 25 basis points impact, the company passed on nearly 22 basis points to dealers by reducing their commission. Now, this, coupled with the asset under management growth, resulted into a strong financial performance for the company. Now, if you see in the last 3 quarters, the AMC has not only seen a growth in its revenue run rate, but also a fall in expenses, which has resulted into a strong EBIT and net profit performance for the company. Mainly in the last 2 quarters, if you see, the company's EBIT and net profit grew 40% plus compared to last year. Lastly, if you see, the improving dividend payout ratio has been also one of the factors that has kept investor interest in this company. Now, if you see the company's dividend payout ratio, that has been continuously increasing over the period from 51% in FY15, it has increased to nearly 66% in FY19. So that is also one of the reasons that has aided this rally in the share prices of HDFC AMC. Lastly, on the analyst side, if you see, not many brokerages are tracking this company. Among the major ones, 3 have a buy, that is Axis Capital, Bufa ML and Morgan Stanley. Now, Morgan Stanley has a target price of around 2,300, while Axis Cap and Bank of America Merrill Lynch have a target price of close to 2,200. Now, only one neutral rating, that is mainly because of expensive valuation that is coming from JP Morgan, and one sell rating coming in from Ambit, also because of expensive valuation and because of the regulatory and the competitive pressures that we have been seeing. Recently in the morning, we came in, there's another note that came in from HSBC. They also have a buy rating. They've in fact upgraded the counter to buy and have also hiked the target price to close to 2,200 rupees from the earlier target price of 1,400 rupees.
All right, so still those heady target prices stick to an HDFC AMC. The stock has been a steady performer and steady wealth creator for all of its investors. So Amit, thanks very much for joining in with that, an interesting piece out there. But that's all that we have on First Word today. There's a lot more lined up on Indian Open as we discuss markets and macros with Mihir Vora of Max Life Insurance, talk about how radio is battling new age music platforms like Gaana, Spotify and YouTube Music with Prashant Pandey of ENIL. And as ACC prepares to report its June quarter results today, we speak to Binod Kumar Modi of Reliance Securities about earnings expectations from the cement companies. But after this break, a full tilt towards today's trade.